Think back to 2013. Andy Murray won Wimbledon for the first time, NASA found calcium-rich deposits on Mars, and Disney's Frozen became an instant hit. Since then, we've had the Ice Bucket Challenge, Great Britain voted to leave the EU, Trump became the US president, and COVID-19 broke out as a global pandemic. And while the world's attention has been pulled in a million different directions over the past decade, investors have quietly been focusing on one thing: real estate. And their strategy has paid off in a big way. But why? What's driven their success in the face of such adversity? How has population growth, migration, inflation, interest rates all impacted performance? And more importantly, is investing in property wise in the current market? As someone who's invested in real estate for over a decade with 1,500 acquisitions under my belt, I've seen firsthand the resilience and potential of various property investments. So in this series, I want to look back at how real estate has performed over the last decade. We'll start with offices. And let me tell you, when it comes to vacancy rates, it's been a wild ride. For the longest time, office spaces were the bread and butter of commercial property portfolios. When investors thought about getting started in commercial real estate, office spaces were always the most promising option. They were like the star halfbacks of the team, reliable, consistent, and always delivering results. In fact, at the end of 2018, office spaces made up 46.2% of Australia's commercial property space. Investors couldn't get enough of this asset class, and for good reason. They loved the stable returns, steady vacancy rates, and high demand that helped cushion the blow of tenant turnover. Then, COVID-19 hit. National vacancy rates shot up 12.4% in 2021 as lockdowns and remote work became the new normal. Fast forward to today, and the demand for office spaces still hasn't quite bounced back yet. The national CBD office market vacancy rate is sitting at 14.9%, the highest it's been since way back in 1995. And to top it off, the total share of office in the commercial property space has dipped to 43.1%. So it's pretty clear that vacancy rates have been on a roller coaster ride over the past decade, from historic lows to unprecedented highs. Now, you might be thinking that with the vacancy rates all over the place, office assets must have taken a big hit, right? Well, not exactly. Despite the recent challenges, office assets have shown some serious resilience over the past decade. They've managed to weather the storm and come out on the other side. In fact, even during the height of the pandemic, office assets were still delivering returns above inflation. That's pretty impressive when you consider the circumstances. But nothing lasts forever. In 2022, total returns fell below 5% for the first time in a long while, and it didn't stop there. By the end of 2023, returns had bottomed out at -6.2%. So what's behind this sudden change of fortune? Well, it's a mix of things really. Remote work has definitely played a part, with more people trading in their cubicles for home offices. But there's also been a double whammy of inflation and rising interest rates. These factors have created a challenging environment for office assets, and they've had to navigate some choppy waters. But here's the interesting thing. When you look at the best performing years for office assets, they all had one thing in common: low interest rates and easy access to debt financing. These conditions have created a favorable environment for office assets to thrive. So while the recent dip in performance might seem like a big deal, it's really just a readjustment after a long period of overperformance. The market is finding its new equilibrium. But the question on everyone's mind is, what's next for office assets? Is this just a temporary blip, or are we looking at a longer-term shift in the market? To answer that, we need to look at a crucial aspect of office asset performance that often flies under the radar: income returns. While overall performance has taken a hit recently, income returns have been quietly chugging along in the background, providing a much-needed buffer against market volatility. Sure, yields have been on a downward trend, but despite that, offices have still managed to deliver positive returns year after year. It's a testament to their resilience. Of course, the pandemic threw a spanner in the works. Lockdowns and remote work became the norm, and suddenly the world of office assets was facing a whole new set of challenges. Landlords were scrambling to keep tenants, offering incentives and doing whatever they could to prevent them from walking away when their leases expired. But despite all the uncertainty, income returns have managed to weather the storm. In fact, they've managed to bounce back in recent years. A big part of this comeback story has been rental growth. It's been a key driver of the resilience we've seen in income returns, and it's also a major contributor to the uptick we saw in 2023. Some CBDs have been standout performers in this regard. Brisbane saw rental growth of 10.6%, Perth was at 9.8%, and Sydney wasn't far behind at 7.5%. These are impressive figures, and they've had a direct impact on the returns investors are seeing from their office assets. It just goes to show how important market fundamentals are when it comes to driving investor confidence and performance. When the underlying market is strong, it can help cushion the blow of external shocks and uncertainties. But between all this talk of income returns, there's another piece of the puzzle we haven't touched on yet: capital growth. Capital growth has been more volatile metric for office spaces, and it's seen some pretty significant swings in the past decade. Back in 2014 to 2016, office assets were enjoying a period of sustained capital growth. Nothing too crazy, but steady and reliable. Then in mid-2016, things started to pick up steam. Growth accelerated and investors were feeling pretty good about their prospects. But as we all know, the property market is cyclical. What goes up must come down, and that's exactly what happened in the years leading up to the pandemic. Growth started to moderate as the market cooled off. Then COVID-19 hit, and again, everything changed. The data shows just how heavy the impact was. Suddenly, demand for office took a nosedive. At the same time, investors started to look more closely at other sectors, like industrial and logistics, that were better positioned to weather the storm. The result? Capital growth for office assets remained muted as we turned the corner into the 2020s. Investors were repositioning their portfolios, and the pressures on property values started to ease. But the story doesn't end there. Throughout 2023, the value of office spaces continued to decline. By the end of the year, capital growth had hit minus 10.5%. That's a big number, and it reflects some pretty significant shifts in the market. In Q4 2023 alone, most of Australia's CBDs recorded a negative demand, with a net absorption of minus 58,700 square meters. That's a lot of empty office space. So what's driving this downward trend? Well, high interest rates certainly aren't helping. They're making it more expensive to finance property acquisitions, and that's putting a dampener on growth. But it's not all doom and gloom. Many experts are projecting a recovery and repricing of office assets in a response to the rate cuts later in 2024. As the cost of borrowing comes down, we could see a resurgence in demand for office space. The key takeaway here is that capital growth is a more volatile metric for office assets, and it's more susceptible to broader economic trends and market shifts. While income return levels have provided a degree of stability, capital growth has been on a bit of a rollercoaster ride. So where does this leave us? What's the outlook for office assets moving forward? Well, the short answer is, it's complicated. There's a lot of moving parts and a lot of uncertainty in the market right now, but that doesn't mean there aren't good opportunities. One of the big things everyone is keeping an eye on is interest rates. Most investors are waiting for rate cuts to signal that economic pressures are easing and that financing is becoming more accessible. When that happens, we could see a surge in demand for office assets. But interest rates aren't the only factor at play. Population growth and foreign investment are also expected to continue driving demand for office space in the coming years. As Australia's population grows and more businesses expand into the country, the need for high-quality office space is only going to increase. Let's not forget about the long-term resilience of office assets. Despite all of the challenges over the past decade, office investments have proven time and time again they can weather the storm. They've survived recessions, pandemics, and everything in between. Of course, the future of workspaces is still a big question mark. With the rise of hybrid and remote working, many businesses are rethinking their office needs. But that doesn't mean office properties are dead. Far from it. In fact, many tenants are showing a strong preference for high quality, sustainable office buildings that meet their ESG goals. We saw this trend play out in 2023, with rental growth driven in part by demand for green, energy-efficient office spaces. So what does this all mean for investors? Well, it means that adaptability is key. The office market is evolving, and investors need to be ready to evolve with it. That might mean repositioning assets to meet changing tenant demands, or exploring new investment opportunities in emerging submarkets. So while there may have been challenges ahead, there's also plenty of reasons to be optimistic about the future of office investments. With the right strategies and a long-term perspective, investors can position themselves to capitalize on the opportunities that lie ahead. And that, my friends, is the story of office investments over the past decade. But you know, as fascinating as the office story is, it's just one piece of the commercial real estate puzzle. And in the next part of our series, we'll be shifting gears to take a closer look at another sector that's been making headlines: retail. So make sure you subscribe and keep an eye out for part 2 of the series. Thanks guys, see you next time.